Buying a house is not always the smartest financial move. That sentence alone might ruffle a few feathers, but is true. In this video, we are looking at the truth about real estate versus stocks and which builds wealth faster. Back in the day, what if you invested in 1980? Back in 1980, let us say you've had $10,000 sitting around. You wanted to grow that money, but had to choose where to put it. This is where it gets interesting. If you had invested that amount into the S&P 500, reinvesting all dividends by 2023, you would be looking at over $1 million. That is a big leap. Now let us shift to real estate. If you bought a home for $10,000 in 1980, based on historical averages, your property would now be worth roughly $120,000. It is still a win, but clearly not in the same league. This gives us a solid benchmark. Both assets grew, but at very different speeds. And yes, there are other factors like rental income and maintenance costs, which we will get into. But just looking at raw appreciation, the stock market clearly pulled ahead. Keeping it under the mattress is not a strategy. Doing nothing with your money sounds safe, but it quietly works against you. If that same $10,000 just sat in cash since 1980, it would now be worth much less in terms of purchasing power. Inflation eats into savings without you even noticing. What used to cost $1 back then might cost more than $3 now. For example, rent in the 1980s might have been a few $100s a month. Today, that same place could easily cost over $2,000. So while your money stays the same in the bank, everything else around it gets more expensive. That is why investing is not a luxury, it is a necessity. Everyone talks about gold, but let's be honest. Gold has a reputation. People call it a safe haven or a hedge. But is it really a strong wealth builder? From 1980 to now, gold went from around $850 an ounce to just over $2,000. That is not nothing, but is a slower climb compared to stocks. If you put $10,000 into gold in 1980, you might have around $24,000 to $25,000 today. That is a big difference compared to stocks or even rental real estate. Gold is good at holding value, especially during crisis years, but is not a compounding machine. It does not pay you dividends. It just sits there. It is more about preserving wealth than growing it aggressively. So while it can play a role in a portfolio, relying on it to grow your money fast is a bit of a stretch. Let me know in the comments. Do you consider gold part of your strategy or just a backup plan? Buying a house sounds smart, but here's the math. Buying a house feels like progress. It is one of those things that just sounds right, but when we look at it strictly as an investment, it tells a different story. The average home in the United States in 1980 cost about $76,000. Fast forward to today, and that number is now close to $400,000. That is a decent return, but it is spread across 40+ years. When you break it down, the annual growth rate is around 4%, and that is before you subtract expenses like maintenance, property taxes, insurance, and interest if you had a mortgage. Compare that to the stock market, where average returns with dividends reinvested are closer to 10 or 11% a year. Also keep in mind that your primary home does not generate income. You live in it. It is more of a lifestyle expense than an asset that works for you. Some people argue it saves rent, which is true, but from a purely investment-focused perspective, it is not doing the heavy lifting like other assets can. So when someone says their home is their biggest investment, it might be true emotionally, but financially, there might be better options. Would you count your home as part of your wealth built-in plan? Stocks do not sleep and they compound like crazy. Here is the thing about stocks. They never stop working. Companies are open worldwide, markets move daily, and your money is always doing something. That is powerful. Let us go back to the $10,000 example. If you put that into the S&P 500 in 1980 and let it sit, including dividends reinvested, you would now have more than $1 million. That is not a typo. It is real compounding in action. And compounding is not just a fancy word. It is money making more money. Then that money makes even more money. Over time, it snowballs, kind of like rolling a small snowball downhill and watching it grow into something huge. Plus, stocks are easy to access. You can start small. You do not need to fix pipes or chase tenants. You just buy and hold. Sure, the market goes up and down, but over time, it has trended up very reliably. So if your goal is to grow wealth faster, stocks have a solid track record. What do you think? Are you leaning more toward the market after hearing that? Now let's throw rental income into the mix. Now, rental properties do have a big advantage that your personal home does not. They can generate steady income month after month. That income changes the game. If you bought a rental property in 1980, not only would the value have increased, but you would also have collected rent along the way. That is income on top of appreciation. Depending on your local market, this could have doubled or tripled your total return. Some landlords also raise rent each year, which helps the income keep pace with inflation. That means your investment continues to grow in two directions, both value and cash flow. But it's not passive. You've got to deal with tenants, repairs, and the occasional unexpected issue. That work should be considered when comparing with stocks, which require almost no effort after you buy. Still, if you are looking for income plus appreciation, rentals are a strong combo. Just be ready to be hands-on or hire someone to do it for you. Let's talk about taxes without making it boring. Taxes might not be fun, but they definitely matter. Real estate has some solid perks here. You can deduct depreciation, which lowers your taxable income even when your property is gaining value. There is also something called a 1031 exchange, which lets you swap properties and delay paying taxes. Stocks, on the other hand, are taxed on capital gains when you sell. If you hold for more than a year, the rate is lower, but you still owe something. And dividends can also be taxed annually depending on your income level. So while both have their tax angles, real estate gives you more flexibility if you play it smart. That is part of why some investors stick with it long term. Does tax treatment ever impact the way you invest? Let me know in the comments. I am curious how much people actually think about this stuff when making decisions. Final score: who actually wins the race? Looking strictly at returns, stocks take the top spot for speed and growth. A $10,000 investment from 1980 to now grew to over $1 million with the S&P 500. Real estate appreciated too, and rental income added some fuel, but it still trailed behind overall. Gold held its value, but it did not grow it very quickly. Cash lost power. So if your goal is to build wealth fast and you can handle some ups and downs, the stock market has shown it can deliver. Real estate still has a strong case for those who want income and physical assets they can control. It might not grow as fast, but it builds steady value over time. No hype here, just numbers. Your goals, timeline, and personal style matter most, but the data tells us who pulled ahead. Are you surprised by the outcome? Let me know if this changed your thinking even a little. Real talk, what should you do with this info? At the end of the day, it all comes down to what kind of investor you want to be. If you are okay with market swings and want growth without doing much, stocks are your friend. If you prefer steady income and do not mind being more hands-on, real estate could be the way to go. You do not have to choose just one. Some of the most successful people build wealth by combining both. Stocks grow their money. Real estate provides cash flow and stability. The key is to start. Do something with your money. Let it work. Waiting for the perfect moment usually ends up being the worst decision. Thanks for watching. Drop a comment, share your experience, and if you got value from this, hit like and subscribe for more money talk that actually makes sense.